Hello, decision makers. Welcome back to Superposed. My name is Aiden Lewis, and today we have the extreme pleasure of all being honorary finance bros. And if you don't like talking about the stock market or finance, don't worry. This isn't going to get too into the weeds with any of it, and I really hope to convey just how powerful and interesting the stock market is as a tool to research people's decisions. Now, this is a topic that is near and dear to me. I've been working as an independent quant or quantitative finance analyst for the past couple of years, and I have really enjoyed how the stock market has taught me about other people's decisions, particularly with high stakes and uncertain decisions. And just a small ask, if you make one decision today to help out me and this channel, please decide to like and subscribe and tell your friends if you found value in this episode. Without further ado, here's the decision of the day. Say you're sitting at your desk. You open up your Robinhood account and see that a stock is up 60% on the day without any signs of stopping. And while the company isn't one that you've ever heard of before, the shares are pretty cheap and there's no denying the momentum on the day. Do you buy this stock? And in a wild turn of events, here's the second decision of the day. Let's flip this. Say that you open up your Robinhood account, and yes, Robinhood, I'm looking for sponsors, wink. And you see that one of your positions is down 60% from when you purchase it. Do you sell this position? Today, we're looking at the stock market not as some amorphous machine, but rather one of the most impactful and prevalent group decision-making arenas in the world. And to highlight the behavioral aspect of the stock market and financial decision-making in general, we're going to take a deep look at the great crash of 1929 and the subsequent bank runs that caused the Great Depression. So at this point, you're asking, why should I care? And here's why. Number one, according to literature, at least 75% of people who trade on the stock market lose money. Two, the Bank of International Settlements, otherwise known as the Central Bank of Central Banks, recently came out with a report saying that potentially the AI bubble in the stock market right now around the globe is potentially going to burst. And on top of that, you know the guy from The Big Short who made a lot of money on the 2008 housing crash? He's betting big that the same bubble is going to burst. And within this story today, we're going to see just how one of these bubbles bursting can cause catastrophic effects when people decide to let their fears run their decision making. And number three, the same pressures that are felt when either buying or selling a stock can be felt in other decisions that we make. And knowing just a few common pitfalls of human decision making can save you more than just your money. And I have to do a little disclaimer here. I'm not a financial professional. This does not constitute financial advice. Trade at your own risk, etc. Don't sue me. Today's literature, linked down below, there's going to be 4 primary articles that we're looking at. Right off the top, we're finally getting into Prospect Theory. Daniel Kahneman and Kahneman Tversky. This is sentinel work in the decision sciences. So check out that paper. We'll talk about it a little bit later. We're also going to talk about this one paper that I think is really aptly named, Trading is Hazardous for Your Wealth, the Common Stock Investment Performance of Individual Investors by Barber et al. We're also going to look at another paper, Who Gambles in the Stock Market by Kumar. And we're going to also take influence from a Sentinel review paper by Richard Thaler and Nicholas Barbaris describing behavioral finance in the field that this discussion currently resides in. So how did the decisions of everyday people lead to the collapse of the American economy? Let's get into it. Now, between August of 1921 and September of 1929, the Dow rose an incredible 504% from 63 points up to 381. This meteoric rise was fueled by unregulated margin trading, where people could borrow money and purchase shares with it, kind of like putting a house on a credit card, just expecting that the parabolic rise would continue forever. And indeed, even just the weeks before the great crash, prominent economists in America said that the stock market was going to be at a permanently high state and that this trajectory would continue. But in just 2 weeks between October 24th of 1929 to November 13th, the Dow had plummeted like Icarus, a staggering 49% from that peak, evaporating nearly half the value in the Dow and coining landmark trading days like Black Thursday, Black Monday, and Black Tuesday. And by July of 1932, the Dow, from that 381-point high, was down to just 41 points, below what it had been in 1921, and the lowest point in the 20th century. The stock market had cratered an 89% from the peaks just a year and a half earlier. And think about this. If this type of move happened today, every single retirement account in America gone in an instant. To put this in perspective, say you had put $100 in a box in 1929, expecting it to double. But when you opened it up, you found $11 inside. Compounding this loss for investors is that those who had traded on margin not only lost that $100, but then had to pay more on top of it to their creditors, sinking people deeper and deeper into the hole. And just for reference, it wasn't until the 1950s and the post-World War II boom that the stock market had reached pre-crash levels. But as you can imagine, those who had traded on margin, not all of them could pay back their creditors. They just lost all their money in the stock market. And so this was the first of many hits to the fragile American banking system at the time. Now, modern banking is what it is today, where your money is insured by the FDIC, creditors have regulations and limits that they have to uphold, and you don't wake up panicking about your stack of dollar bills in a vault somewhere because of the Great Depression. Now, after the Great Crash in 1929, there were 4 mass banking panics that occurred in the early 1930s, where storms of people would flood their local banks, demanding to withdraw the money that they had deposited with them, because they were worried that they would never see their savings ever again if that bank had collapsed. Ironically, these mass waves of bank runs closed down more than 9,000 banks in America. That's almost inconceivable today when the financial sector just posted record high earnings levels. Think about the change just in the last 80 years. And for those of you who have seen the movie It's a Wonderful Life, this is what's going on when everyone's storming the bank and the town shuts down. And so these 2 mass group decisions, 1, the Great Crash of 1929, and 2, the subsequent bank runs of the 1930s, brought the nation to its knees with a little help from decisions by the Fed and President Hoover at the time. And these same patterns of behavior can be seen even just last year when the S&P fell around 16% when President Trump rolled out his tariff plans on Liberation Day. Or during COVID, when markets across the board dropped about 30%. But the markets aren't just some wild animal that run amok and rise and fall based on its own whims. Whether in 1929 or in 2026, the stock market is just a bunch of people making a group decision based on what shares are worth. And those bank runs are just people like you and me deciding that their money is better in their own hands rather than the banks. So let's look through the lens of quantum cognition and better understand how people make the decisions that cause the great booms and busts of our economy. And as always, our 4 pillars of quantum cognition are 1, superposition, 2, interference, 3, contextuality, and 4, non-commutative effects. If you're looking for a deeper dive into these pillars, I recommend checking out episode 8, our deep dive into quantum cognition. But before we dive into these 4 pillars of quantum cognition and how they apply to these financial decision makings, I want to reframe how we think about the stock market. And so we're looking today just at equities, at shares of companies. And so generally, this is how the stock market works. A company decides how much of its equity or how much of its ownership it wants to give outside investors the opportunity to purchase. This is often a fundraising move or a move by internal shareholders to increase their own share value in the company subsequently. And so let's think about first, what even is a company? And I posit this idea for you to ponder. A company is really just an imaginary thing. It's an idea. Amazon is just an idea that a group of people have gathered around and said, okay, we're going to deliver this need to society. And that's going to be our company. Now we're going to shore it up. We're going to have different mechanisms to regulate it, to exchange funds. But ultimately, it's an idea. Amazon really only exists when people decide that it exists. And so what are shares of companies? Well, a share is just an imaginary fraction of an imaginary thing. The company can't even break up certain ownership of the entity. And so the shares that are traded on the stock market are just metaphysical representations of bits of ownership in that company or bits of ownership in that idea, which in itself is also a concept for these imaginary shares of an idea that you like. And people can swap these shares by buying or selling them from other people on the stock market. A little more tangibly, there is a price associated with the share. For example, today, one share of Apple common stock is ticking at around $343 after reclaiming its spot as the most valuable publicly traded company just a couple days ago at a market cap of over $5 trillion. But this doesn't necessarily mean that the stock is worth $343. It only means that someone paid $343 for the stock. There is no set price for these shares. It is quite literally only what people decide to pay for them on the stock market. And so the actual value of a stock is whatever you decide it to be, i.e., you decide the value of these imaginary things. Think about crypto. Some people really value crypto, and so they might buy imaginary coins for $128,000 a pop. Other people think that crypto is worthless, and so they choose not to buy it. But let's go back to Apple. Today, the trading volume is around 29 million shares, meaning that people had to decide what to sell those 29 million shares at, and other people had to decide what to buy those 29 million shares at. Maybe $343 is too much for one of those shares, and maybe $343 isn't enough for one of those shares. Maybe I bought some of these shares for $200, and so now I'm deciding if I should liquidate these positions or hold on to them to see if they increase in value, or wait to see if people decide that their value is worth more in the future than they are right now. And so the stock market really is just a way for groups of people to come together and decide what the monetary value of a part's ownership in a company is worth, or what a share is worth. And so there are spectrums of people, both on the buy side and the sell side, who are trying to decide if the price that the last person who bought a share of the company aligns with what they believe the future outcome of the stock is going to be. Because, of course, the primary function of the stock market is to make money. So with this idea of the stock market just being an instrument of group decision making, let's dive into our first pillar of quantum cognition. Starting with the superposition here, we're going to keep things super simple. And really, this is the first decision anyone makes on the stock market. And that is to buy, to hold, or to sell shares. And fundamentally, this is what it comes down to, a trinary decision. And for all you finance gurus out there, of course, after you make this first decision, there are layers of decision underneath to modify that decision. But we're going to keep it super light today. Going into our second pillar of quantum cognition, interference, there can be a multitude of internal interfering factors, but today we're just going to cover 4 that are highlighted in Prospect Theory. Yes, decision makers, it is time to discuss Daniel Kahneman and Kahneman Tversky's paradigm-shifting work. Prospect Theory is one of the bedrock theories within the decision sciences that highlight the different internal forces that contribute to a person making a decision. This model was actually developed, amongst other things, using financial decision-making as a proxy, and I think you'll see just how closely it maps into our case study of the pre-Great Depression era. And so in Prospect Theory, there are 4 things to keep in mind about how people make decisions. Number 1 is the reference point. And so each decision, you create a timeline in your minds. And so this could be considered a contextual element. But for example, say that your buddy says X stock has increased $5. Well, if that $5 happened over the last 10 years, that may not be as impressive as within the last day. So you need a reference point. Number 2, and this is a big one, loss aversion. And so in Prospect Theory, it is described that people will avoid losses rather than pursue equivalent gains. And we can all feel this. A $100 loss is more ouchy than a $100 gain. And so people are going to really try to mitigate any losses because it is so viscerally and emotionally felt. Number 3 is diminishing sensitivity, meaning that either after gains or losses, the further away from the start point or that reference point you get, the less sensitive to change you are. And so say you've already made $150 off of a $10 stock, $155 isn't going to feel as incredible as that first $5 right off the bat. Similarly, if you've already lost 80% of the stock market, people are going to be less sensitive to that last 9% to the bottom because, after all, you're already in the hole. And number 4, this is really true and very, very human, is probability weighting. And it is described that people place more probable weight on occurrences that are less likely to happen than on occurrences that are more likely to happen proportionally. What does this mean? Is that people will bet or they'll gamble that something with like a 1 or 5% chance of occurring, they think that's going to happen more often than what is statistically probable. Likewise, they're going to weigh less what is going to be more likely. And so we see this all the time in behavioral finance when people are going to place more money on what are called lottery stocks, which is exactly what they sound like, because they think that these low probability occurrences have a higher chance than they actually do. And they're going to completely ignore the overwhelming odds that they're just going to lose that money. And so we're going to revisit these 4 core concepts in Prospect Theory, especially loss aversion. But we're going to go on to our 3rd pillar of quantum cognition today, which is contextuality. Now, in the stock market, there's a plethora of contextual elements that could be at play. But the big ones are prevailing news, reports, earnings, economic data, and industry-specific events. And if you're interested, people actually develop whole trading strategies around these contextual events and what are known as event-based or catalyst-based trading strategies, which literally just look to capitalize on the contextual elements of our decisions. And while I think there could be some convincing arguments to be made about the non-commutative effects of the stock market decisions, we're not going to get into it today because it gets pretty messy. And plus, I want to focus really on the internal interfering factors that are going on. And so taking our pillars of quantum cognition, let's take a look at our decision frame in the 2 different epochs we're talking about. First one in the pre-1929 crash, and then the second during the 1929 crash and the bank run of the 1930s. So let's look at the boom in the late 1920s. This is when the Dow rose 504%, which is absolutely inconceivable. We're looking at the contextual elements at play are it's post-World War I, America's victorious, New World Order. This is the Roaring '20s era. So our economy is great. People are spending a lot of money. Everyone's looking very, very bullish just in all aspects of life. And so these contexts and the way that people are making decisions within this era are going to cause that bubble, that huge 504% increase in the stock market. And people are going to give greater probability weight to the small chance that that is going to continue on permanently, and they're going to ignore the large probable outcome that that bubble is going to burst. Additionally, think about loss aversion here. When the market's moving up, people are going to feel loss aversion in a really interesting way, in the fact that they're not going to want to lose out on the opportunity. They're seeing people make money. They're seeing this huge increase. It's looking like it's going to be permanent. And so they're going to hop on the bandwagon here in herding events. And on top of that, we have the very laissez-faire margin trading rules. And so people are borrowing money. They're making a lot more money. People are seeing that. They're not going to want to lose out. So then they're going to hop in too. And so you get this meteoric rise of the stock market in the late 1920s. However, the shoe fell in 1929, especially on Black Thursday, when that bubble initially popped. And so people are going to say, oh, we thought that this wasn't going to happen. People get scared, started smelling fear in the air. And so over the course of those 2 weeks, when 49% of the Dow was erased, people are then going to feel that loss aversion in a different way. Now they're saying, oh my gosh, I'm losing money. I don't want to lose more money, so I'm going to pull out. And so you have this mass exodus of people deciding that they don't want to lose more money, and so they're going to sell, which drives the market down. But what if you're not someone who invested in the stock market? Maybe you're, just a farmer in Oklahoma or something like that. Well, in the 1930s, now you have the great crash of 1929 as part of the context. You're seeing this massive drop within one of the great leading indicators of the economy. And so you're going to start panicking. Now you might be thinking you don't want to lose your money to the banks because the banks are vulnerable now because the stock market crashed. Not only that, you're seeing all your neighbors have the same worries. And so collectively, it starts to construct this constructive interference within the zeitgeist. And so you and your neighbors might coalesce and decide that you're going to go down to the bank and demand your money back, and thus causing that bank to close. And so we're seeing the same factors within the 1920s, that great boom, also working in the opposite direction in the Great Depression. People now are going to be so scared to enter the economic arena that the economy is just going to stagnate and stay depressed for years and years and years, really until FDR and World War II. So why did I bring up this case study, and what does it mean for you? I just want to reiterate that the same psychological principles that drove the stock market up fivefold in the late 1920s also caused that 89% drop in the Great Crash. And these same psychological pressures are what drove Bitcoin up to $128,000 and then down to around $60,000. And those are the same pressures that drove GameStop up to $87 and right back down to $11. And so whenever you get a notification on your phone that the S&P is up 1,000 points, or you get your friend telling you how much their BS coin is up, I give you permission to take a step back and not be a part of the herd that is chasing loss aversion. And we see this every day, even in normal marketing. Like, think about how many times you've heard, hurry now, the sale won't last. people, and it works. This is why they use it, is because people don't want to lose out on that deal. And so it brings people in masses to those sales. Another practical point is when the market's down, don't panic and sell like everyone else and chase that loss aversion. That's actually the best time to buy. We also talked last week in episode 10 about JFK and the Cuban Missile Crisis, just how potent social perception can be in our own decision making. And these are those forces at play right now. If everyone is hopping on the boomer bust train, they're going to expect you to do the exact same thing. But if we've seen anything today, it's that this may not be what an intelligent investor does. Instead of letting social perception and loss aversion hijack your investment moves, control your own decision making. This is one of the first instances that we've seen here on Superposed where internal interfering factors really dictate decisions. And if you're looking for alpha, this is a great way to see it. Because contextually, the stock market is dynamic, but less so on the second-by-second ticking of people making decisions about what a stock is worth. So one could reasonably understand, under different contexts, what the superposition of that asset should construct to. And if you really want to get fancy, the superposition of an asset is any price for that asset, and it shifts based on the contextual elements of the broader market and the internal interfering factors of investors. But as we've seen, and what we know intuitively, is that people don't make rational decisions. And therefore, internal interfering elements can shift that superposition outside what would be expected under different contextual regimens. This causes a mismatch in pricing that can be capitalized on if you don't get taken along for the ride in these mass loss aversion herding patterns. Let's take a step back for a sec and think about this paradigm, particularly loss aversion, outside the realm of finance. Politically, people often vote because they don't want to lose their way of life, lose certain rights, lose different benefits that they are granted, etc. And again, this isn't a show about politics, but think about how people on both sides of the aisle believe that they will lose something if the other side wins. And so this is how you get a country in gridlock, is that both sides are feeling such potent loss aversion that it polarizes from the middle and gravitates towards their party. Media companies understand this, and this is why we will oftentimes receive texts, see ads, or hear on the radio about what will be lost if X candidate gets elected. This messaging understands that negative emotions sting more than positive emotions feel good. And this messaging then herds people to their side's position. And just a quick aside, this fear-based marketing also creates an uncertain decision environment. And as we saw in episode 9 with FIFA, is that people gravitate towards what is certain under uncertain conditions. So people are going to gravitate to their side's position, not only because of the loss aversion, but because they know it's certain. So when you find that people are trying to make you afraid of losing something that isn't lost, take a step back out of the herd and take advantage of people's fears. But if we've learned anything else today, is that our society is built on imaginary things that can change at any moment and collapse the world economy. And on that cheery note, check out the Superposed Substack, where we discuss the science behind visualization and show that it works even if you're not an athlete. And also check out the Superposed YouTube at superposed_decisions for more. And tune in next week for our discussion on Sam Bankman-Fried's decisions and how that caused his fall from grace as the crypto king. Also, thank you all so much for all the amazing feedback on Superposed. Please let me know what's working for you, what's not, and any advice on how to make Superposed even better. If you found this episode valuable, please consider liking and subscribing. It goes a long way in helping a small channel like this reach its potential. And as always, the decision is in your hands. Thank you for listening to Superposed. Aiden out.